Dr. Michael Burry is one of the greatest investors of all time. While a lot of folks know him from the great financial crisis in terms of making a monster bet on subprime that worked out very well while other people were losing their shirts, prior to that, he was a very successful hedge fund manager just finding cheap stocks, compounding at great returns. And that's primarily his background, finding these things that are just sort of beaten up. Maybe it has too much debt. Maybe there's just an ick factor with the company that just made it cheap. He finds these things using a hyper analytic process to find these things and say, hey, this is worth the risk reward. So when I saw that here it is, he's been buying CVS during the last few quarters, it really got my interest buying stock, buying call options in CVS. As I've dug deeper, I've seen, wow, they have a lot of free cash flow that they will start returning to shareholders likely in the coming year. And the amount of free cash flow equates to 10% plus yield to shareholders. That is very interesting. The reason why a lot of folks don't realize it yet is because CVS has been paying down a significant amount of debt from a recent Aetna acquisition just back in 2018. So a lot of folks think of CVS as sort of a stale retail pharmacy, but the reality is CVS is onto a lot of other things. They're rapidly adopting sort of a vertical approach to healthcare, which is really interesting, which could even make them unrivaled, which is not even what I expected when I initially started doing my analysis on CVS. Let's dive right in to understand what's going on here. And so, as we look at this, the reality is they actually have really three core segments that drive their results. There's pharmacy services, retail, and that's the component that a lot of folks think of, and healthcare benefits, which is primarily their Aetna acquisition from a few years back. And you can see their adjusted operating income is around $6 billion for each of these segments. So you could think about it as about a third each of these different segments, give or take. And so when we go through these different segments, let's start with the traditional segment that most people are familiar with, the sort of this major, maybe you would even think of it as a stale or not a hyper growth business, but they have nearly 10,000 retail locations, 1,000 plus minute clinics. So these, clinics where it's very easy to either see a nurse or a doctor to get a quick checkup. They've dispensed nearly 27% of total retail prescriptions in the US. And when you look at their business model, about 76% of their revenue is from pharma, where the rest is from storefront. You're buying either, cold medicines or, you just see a bag of chips or a soda. I generally viewed this segment as not unrivaled, and that's the reason why I wasn't that interested. But as I've dug deeper, I go, wow, there's actually a lot going on here. For example, this Aetna acquisition, which they started in 2018, or they acquired in 2018. Now they've effectively become one of the largest U.S. healthcare benefits providers, coverage of around 34 million people, with coverage across 1.4 million providers. So that's the doctor network. Think lab equipment, specialty doctors, and so you can see here it is. They've gone from the traditional retail to also providing healthcare, which is really interesting. And you could see sort of how they're thinking about that, dealing with, you sort of cross this barrier from not only a retail, but now let's start focusing on walk-in clinics. Maybe that could create some sort of lower cost healthcare development. Still, if you were to look at it on a siloed perspective, you'd say, wait a second, U.S. healthcare, a lot of competition, not unrivaled as well. Then the third key segment is this pharmacy benefit manager. So we've talked about effectively this component, which is third-party payer health plan. I'd argue you should probably just pause this to sort of see, because this is the layout to understand how sort of the pharmacy distribution and reimbursement system works. This is from CVS to understand there's multiple different pieces, but this is their Aetna, their health insurance operations effectively. The pharmacy, their CVS pharmacy, this is primarily here, but this next component is their pharmacy benefits manager, which is this piece. So if you want to pause it just to sort of see all of this and see how it walks through, I would do that for a second. But to understand what does the PBM or pharmacy benefit manager do, what you're really looking at is designs and administers prescription plans for various health plans. So they help these health insurance plans. And they effectively encourage the use of generics. They help establish, okay, these are the different, prescriptions that you should be willing to cover. These are the different amounts. This is the reasonable price range for it. And it's enabling different plan designs and payment levels for various different treatments. Oh, okay, well, if you're a health insurance plan, you can now offer different tiers, let's say for your different health insurance members, and saying, oh, you know what, you want to pay 50% of your prescriptions out of pocket. Yeah, we can set you up with that. So this is their way of sort of health insurance plans offloading the prescription component of healthcare to this pharmacy benefit manager that then coordinates it with the rest of the system. So they coordinate it with sort of the manufacturers to figure out what prescriptions they're willing to cover, as well as the pharmacies in terms of how much they're willing to pay for certain types of treatments. And so that all sort of flows through. But these are the three key components that they now own, which is really interesting. So you have the health insurance company working with the pharmacy benefit manager, which is then working with the pharmacy. So almost like one-stop shop from a customer perspective. And so their view when they look at this is, well, on an individual silo basis, none of them are unrivaled. Here, a recent quote from their second quarter conference call was interesting, where they said, with Aetna's strong networks and CVS's significant local presence, we believe we are creating a compelling new offering that combines health insurance, pharmacy, our retail presence, and behavioral health services. This is something that no one else can deliver. This makes me wonder if indeed CVS is potentially creating an unrivaled position for themselves. It's not 100% clear to me yet in terms of their financials. That said, they have targeted saying, look, based on combining these different segments, you could potentially get billions of dollars of cost savings over time. Now, what they've been doing recently with the significant free cash flow that this business generates has been to pay down their debt, because they have a lot of lease debt as well as debt tied to the Aetna acquisition. So they were at 5 times effectively at the transaction close, 5 times leverage ratio, which is quite high. And so now they've been paying down this debt, billions of dollars a year paying it down. And so now in 2022, literally, months away, you're going to start looking at a business that's in low 3 times leverage. Now that's still quite a bit of leverage, but for a business that's quite stable, that is very interesting to me, because and this is what they said in 2019. Yeah, our focus is going to be to pay down debt. That's what we're going to do. 20% capital expenditures, the vast majority of their cash flow to pay down debt. And they would say, yeah, our only commitment is effectively dividends. But starting in 2022, expect $10 billion to $12 billion cash available annually for enhancing shareholder value. Now that can mean mergers and acquisitions as well, but if they don't find a deal every month or every year, that's a lot of free cash flow that can be returned to shareholders. Now, it may not be as a dividend that a lot of folks like. I personally prefer share buybacks if the stock is cheap enough. And so this could create a really interesting situation, because if you're able to buy back stock at a cheap level, then it gets very interesting. And keep in mind, this is what they said in 2019. In 2020, they generated $13.5 billion in free cash flow. Now, part of this was a sort of one-time benefit from COVID, because their health insurance costs weren't as high as they would expected, because a lot of people weren't seeing doctors or weren't getting routine treatments. Now, as I'm looking at this, I'm thinking 10 to 12 billion in free cash flow versus this $110 billion market cap. This is where I'm getting like, wow, this is effectively a 10% plus free cash flow yield to shareholders. Now, if you were to look across this market environment where you're looking at bonds with 2%, junk bonds at 3%, and inflation at 4 or 5%, seeing a company that could be returning they could do a 10% dividend if they wanted to at current price. They're probably not going to, because when you do that, you lock yourself into future capital allocation policies. But they could start buying 10%, 8, 9, 10% back of their stock each year just based on the current price. And that's really compelling, because then as a shareholder, you sit back and you watch as your piece of the pie grows by that same amount, 10% a year, just sitting back. And so any sort of organic growth gets sort of layered on top of that. So 8, 9, 10% plus if you're able to get low single digit growth. That's pretty interesting. And so, as I'm looking at this, It's starting to smell pretty good. Now, what are my thoughts in terms of the valuation, upside downside from here? I'm going to do a quick plug. Or if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no hype, mission focused channel trying to find you exceptional companies and unrivaled investments. I'm looking for potential multi-baggers, folks. Types of stocks that could potentially go up hundreds or even thousands of percent over time. If you're interested in following what am I personally doing, go to unrivaledinvesting.com. First week of the month, I call it my full portfolio. By the end of the month, I call it a potential multi-bagger. And also on a daily basis, I'm interacting with the Unrivaled Nation on our exclusive Discord server. So check that out at unrivaledinvesting.com. Click on Journey if you're interested. And also, once again, please hit that subscribe and thumbs up button if you're enjoying this video. And so as I'm looking at this sort of valuation framework, this is a little different than what I usually do, because I'm not going to be penciling out what do I think the margins could be. It's more like penciling out their approximate free cash flow. So around $112 billion market cap, the $85 stock price, implies, based on what their free cash flow is this next year, it should come down a little bit because they did have one-time benefits last year. And so you're looking at effectively a 10% plus free cash flow yield to shareholders. Now the question is, are they going to be using that to pay down debt further? Probably not a lot more. They said they're comfortable with 3 times. Maybe they bring it down to 2 times and you wait a year or two. Okay. So then what's the underlying growth for CVS in the years ahead? And once again, I'm assuming, let me try to be conservative and say 0 to 5% free cash flow growth in the years ahead. So that effectively says in 5 years out from now, I'm trying to have a logical framework. 5 years from now, I'm thinking about this. You're effectively generating $11 billion in free cash flow to $15 billion in free cash flow based on a free cash flow growth rate of 0 to 5% annualized over the next 5 years. And so how do investors treat that free cash flow 5 years from now? And if in 5 years from now, investors wake up and say, wait a second, getting a 10% yield on this business that's very stable, that's vertically integrated, that includes all these key components, it shouldn't go much lower than that. So maybe it just stays at 10 times, and you get the equivalent of a few percent return to you as a shareholder, whether or not it's a dividend and buybacks. I very conservatively, in my opinion, put 4% here. I don't think that's really reasonable. I think the reality is maybe it's closer to 8-9%. So that way, that's how you think about what's your shareholder yield over time. So it's not only what's your price change, which is free cash flow times by a multiple. That's sort of what's the end market cap. But you're also going to have, well, what's the free cash flow that's returned to you over time? And here it is. I'm saying, well, it's a range of 4 to 8% on an annual basis in the years ahead in terms of what you're getting as a shareholder. And on the upside, I'm effectively saying, investors wake up in a few years from now and say, I'd be comfortable getting, a 6% equivalent yield, making it around 16 times earnings. And in that case, it's a $250 billion company, and the stock price has gone up 120%. This is off the $15 billion in free cash flow. Meanwhile, if investors just wake up between now and then, and it's effectively staying at a 10% multiple, or maybe it goes up a little bit between now and then, you're going to get the equivalent of 8% that they could return to you as maybe buybacks. I'm trying to be conservative in this figure. So I'm looking at this and I'm saying, wow, this is one of those situations where, heads, I win potentially a lot, and tails, I don't lose that much. So I'm looking at this and saying, no wonder Dr. Michael Burry is buying this. It's a statistically cheap stock. Now, in fairness, I actually haven't started buying CVS. I'm still looking at it and thinking about it. I personally think that as I look at this ecosystem, there might actually be another play to consider it that might just sort of benefit from the recent dynamics that have gone on with CVS as they've sort of looked at vertical integration. But I'll save that for exclusive commentary for the Unrivaled Nation, and I'll also update them there if I ultimately do decide to pull the trigger on CVS. Also, my most recent potential multi-bagger company at effectively 4 times sales, growing at 200 to 300% this year. So check that out if you're interested. If this video, has been helpful for you learning about why is Dr. Michael Burry buying CVS stock, and hey, whoa, I wasn't expecting a 10% shareholder yield here that shareholders might start expecting in the coming months. If this has been helpful for you, please make a point of hitting that subscribe button, hit that thumbs up. Thanks so much for watching.